Welcome to a deep dive. This is where we take your sources and really unpack the most interesting bits.
That's right.
Today, we're digging into the real estate market in Raleigh, North Carolina. We've got some articles you sent over, written interestingly from the perspective of private money lenders. They're talking investment potential there.
A specific lens for sure.
Exactly. So our mission here is to figure out why investors are looking at Raleigh, especially, investors using financing like hard money loans. What are these sources actually pointing to?
What makes it tick for them?
Yeah. Get ready for some, I think, pretty surprising facts and numbers about what's happening on the ground there. Okay, let's get into it.
Well, what jumps out right away in these sources is how direct they are.
Yeah.
They cut straight to what matters for an investor, especially one thinking about private finance.
Right. Less fluff, more number.
Exactly. They kind of bypass the general market chat and go straight for the dynamics that, drive profit or manage risk, specifically from that lender viewpoint.
Okay. And the very first thing they seem to hit on, like right out of the gate, is speed. They really lean into how fast things are moving in Raleigh, property-wise.
They do.
What are they saying about days on market?
They're stating properties there, typically they're on the market for about 30 to 35 days.
Okay.
And they make a point of comparing this pretty directly to the national average, which they peg closer to 50, maybe 60 days.
Wow. So nearly cutting that time in half compared to nationally, that feels huge, especially if you're using that short-term, maybe higher cost capital, like hard money.
Oh, absolutely.
How does that speed, like, specifically hit the bottom line for an investor or, factor into a lender's math?
It's completely critical. I mean, think about it. For flips, or even if you're just doing a rehab for a rental, every single day that property sits, it's costing you.
Right. Interest payments, insurance.
Insurance, utilities, taxes, potentially. So if you shrink that time between buying and selling or refinancing, you just slash those holding costs.
Makes sense.
And then from the lender's side, faster turnover means they get their capital back quicker, less time exposed on what might be, a slightly higher risk asset-based loan. It signals strong buyer demand, which makes their exit strategy look much more solid.
Okay, so speed, big factor. What about appreciation? Are these sources suggesting you can expect property values to, like, jump up quickly?
They definitely highlight appreciation, yeah. It's another major draw they point to. These articles pretty consistently say Raleigh's appreciation rates are outpacing the national average, usually landing somewhere in the 4 to 6% range annually.
4 to 6%, that's pretty steady. How does that rate specifically help someone using private money? Because that often comes with, higher interest rates than a bank loan, right?
It does, and that appreciation provides a really important cushion. So yeah, private money rates might be higher, maybe 8–12% annually, somewhere in there. But having 4–6% appreciation helps eat into those financing costs, especially if it's a slightly longer flip or rehab project. And for the lender, that steady value growth, it actually improves the loan-to-value ratio in their favor as time goes on.
Ah, right. More equity builds up.
Exactly. More equity in the property acts like extra security for their loan, making it less risky for them. It suggests the collateral itself is getting more valuable, safer, even if the market, wobbles a bit.
Okay, so fast sales, check. Healthy appreciation, check. What about the costs of just owning the property once you've got it? Did the sources get into things like, say, insurance or ongoing expenses?
They did, yeah. And this is framed as another significant plus for Raleigh. They specifically mentioned average homeowners insurance costs, putting them around $1,100 to $1,300 a year.
$1,100 to $1,300. That sounds, quite reasonable, actually. How's that an advantage investment-wise, particularly maybe for someone holding rentals?
Well, it's a real difference, especially if you compare it to, say, coastal markets or places prone to big storms or whatever.
Sure, where insurance can easily be double that or more.
Right. $2,000, $3,000, easy. So that lower $1,100, $1,300 figure, it makes a real dent in your monthly operating costs, improves your cash flow on rentals. And for a lender looking at a rental deal, lower operating costs mean a better debt service coverage ratio. Basically, the property makes more cash compared to the debt payment, makes the loan look safer.
And it wasn't just insurance, right? They touched on the wider cost of living, too.
Exactly. The sources put Raleigh's overall cost of living index just under the national average, usually around 95 to 98, they say.
So 2 to 5% cheaper than the average U.S. city.
Just a pretty big draw, yeah.
Yeah.
That affordability helps attract people and keep them there. And a growing population needs places to live which fuels both rental demand and buyer activity.
And it all circles back.
It circles right back to support those fast sales and the appreciation rates we were just talking about. It's fundamental.
Right. And that strong rental demand is obviously key for a lot of investors. So what do the sources say about the rental market itself? Is it strong?
They describe it as robust, yeah. Average rents for, let's say, a typical single-family home are listed between $1,300 and $1,500, potentially higher for fancier properties.
Okay.
And those rent figures, combined with what the sources call relatively affordable acquisition costs, especially compared to other big tech cities, creates opportunities for, positive cash flow.
Mm-hmm.
They even specifically mention the market being good for BRRRR strategies, buy, rehab, rent, refinance, repeat.
Right. The BRRR method.
Yeah, where you buy something, fix it up, rent it out, then refinance to pull your initial cash back out, ideally. These conditions seem suited for that, according to the sources.
Okay, so we've got speed, appreciation, lower operating costs, good rents, general affordability driving population growth. But what's the engine? What's like the fundamental thing behind all this, according to these articles?
They point very directly to the Research Triangle Park, RTP.
RTP, right.
They describe it as, one of the biggest, most successful research parks globally. Hundreds of companies, lots of tech, biotech, life sciences.
Yeah, I remember the sources naming names like IBM, Cisco, Microsoft having a big presence.
Right. And that park just acts as this huge job creation machine. It pulls in a steady stream of, well-paid, skilled professionals.
The kind of people who need housing.
Exactly. The people who need quality housing, whether they're buying or renting. So it makes the market really attractive for investors playing either side. It just creates this baseline economic hum that supports property values and demand.
And the universities there, Duke, UNC, NC State, they play a big part too.
Absolutely crucial. The sources really highlight the impact of those three major universities. They stress that it's not just students needing housing while they're there.
Right, it's the graduates too.
Critically, yeah. They produce thousands of grads every year. And a lot of them stick around because of the jobs at RTP and other local companies. It fuels the talent pool.
Which attracts more companies.
Exactly. It's this cycle of education and job creation. Makes the area really appealing for more businesses, which just reinforces the economic growth that props up the whole real estate market.
So it sounds like that combo, the RTP job engine, the university talent pipeline, leads straight to pretty serious population growth.
It really does. The sources flat out say Raleigh's seen a population jump of over 20% in the last decade.
20%, wow.
Positioning it as one of the fastest growing metro areas in the country. And rapid population growth, well, that directly means more demand for housing.
Simple supply and demand.
When demand outruns supply, prices go up great for flippers. And you get steady demand for rentals. Great for buy and hold folks. It's a fundamental driver they keep coming back to.
Okay, so given all these dynamics, do the sources get specific about where in Raleigh might be interesting for investors using private money, maybe for different kinds of strategies?
They do mention a few key areas. Yeah,
Yep.
downtown Raleigh gets highlighted. Apparently undergone a lot of revitalization.
Okay.
It's attracting, younger professionals, but also some empty nesters. So maybe strong potential for quicker flips, using short-term hard money perhaps, to jump on that pace of change and resale value.
And what about investors looking for something more stable? Maybe longer-term rentals?
For that, they point towards North Hills and the sort of wider Midtown area.
Yeah.
Presented as more established, stable neighborhoods,
Right.
attractive to families, good amenities, schools. So reliable rental demand, steady appreciation. Seems suitable for investors maybe using acquisition loans or bridge loans for rental properties.
And where would you look if you wanted to find value, maybe potential for bigger gains through fixing something up?
That seems to point towards East Raleigh. The sources suggest investors looking for potentially higher appreciation, through value-add strategies, are looking there.
Okay.
They mention gentrification as a factor, creating opportunities for significant equity gains, especially through fix and flip projects where, hard money is pretty common for the purchase and the rehab costs.
So interesting how throughout this whole breakdown of the market's strengths and what's driving it, these sources coming from private money lenders, they keep looping back to the financing, specifically hard money. Why do they emphasize that kind of funding as the tool here?
Well, because the conditions they describe in Raleigh, especially that speed we talked about first, they perfectly match the main selling points of private or hard money.
Oh.
These lenders highlight their speed. funding deals, they say, typically within 7 to 14 days.
Which is critical if good deals are vanishing fast.
Precisely. That speed lets investors lock down properties really quickly, often much faster than conventional lenders who might take, 30, 45 days, even longer. Essential for distressed properties, auctions, bidding wars.
Right.
And the flexibility is also key.
Right.
Hard money lenders are often more willing to finance properties that need a lot of work or maybe don't fit the neat boxes traditional banks like.
Which fits those value add or fix and flip plays in East Raleigh or downtown.
Perfectly, yeah.
Yeah.
And they can also fund things like new construction or land deals out in the growing suburbs, which, again, standard banks might be more hesitant about.
Did the sources mention anything about Raleigh's sort of longer-term resilience factors beyond just the current numbers?
Yeah, they do kind of wrap up by touching on things that suggest longer-term strength. They mention stuff like North Carolina's generally business-friendly environment taxes, regulations attracting companies.
Okay.
Raleigh consistently ranking high for quality of life, which obviously makes people want to live there. Ongoing investments in infrastructure, both public and private. And even, interestingly, a relatively low-risk profile for major natural disasters compared to a lot of coastal or earthquake-prone areas helps protect property values over the long haul.
Okay, so let's try and sort of pull this all together. What does it all mean? We've looked at the data these sources are presenting, that really fast market turnover, 30-35 days on market. The appreciation rates beating the national average, 4-6%. The cost advantage is lower insurance, around $1,100, $1,300 a year, and that slightly lower cost of living index, 95, 98.
And the solid rental potential, $1,300, $1,500 average rents they cited.
And we've seen the engines behind it, Research Triangle Park generating jobs.
The university's feeding the talent pool.
And that big population growth, over 20% in a decade. It does paint a pretty compelling picture for investors, especially active ones, based on these sources.
Yeah, it seems to converge into what they present as a really strong case.
And these sources consistently frame strategic financing, especially hard money, highlighting its speed, like 14-day funding, and its flexibility as basically a necessary tool to actually act on these fast-moving conditions.
Right. Whether you're doing fix and flips in, say, East Raleigh, or looking for stable rentals in North Hills Midtown, or even developing something new.
The speed and flexibility of the financing is positioned as key to making those strategies work there. Essentially, yeah. According to these materials, Raleigh offers this potent mix. You've got dynamic growth, but also underlying stability, and it's still relatively affordable compared to some other big tech centers. That seems to be the core investment argument, especially for strategies needing quick, flexible capital.
Okay, so based on everything these sources lay out, here's something interesting for you to think about. If major drivers are things like job growth tied to specific physical places like RTP and a quality of life that pulls people in physically, how might the ongoing, maybe permanent shifts we're seeing in remote work trends or just changing ideas about where people want to live, how might those things specifically impact the long-term investment resilience of the very neighborhoods these sources are highlighting today? Something to chew on as you think about the future of markets like Raleigh.